Good morning, everybody. Mike Nelson, CEO of Ocean Lending Incorporated. And look, I certainly know everybody is having a hard time right now. I know everybody is affected, impacted, suffering from all that we're going through. So we really want to lift out encouragement to everyone in a tough time that we can, persevere and get through this together. And look, my business is being impacted as well. I've got investors who are canceling loans right now, and I think probably for the right reasons. I hate to say that, but probably. And so we're all being impacted by this. But I really do have an overall level of optimism that the real estate industry in the United States is strong and has the strength and the wherewithal to get through what's going to be a challenging time. So I'm certainly not Pollyanna about any of this because it's not. It's not going to be easy. On the other side, I think there's a lot of things that we can look together and realize that we can leverage the strength of the real estate market and get through this in a better fashion. So I'm just going to talk for a few minutes today. You can see this slide. I've got one other slide I'm going to talk about. So first off, market dynamics, and these are my guesses. This is where I think we're going to be. But look, exuberance or despair is not going to serve us well. Exuberance meaning, everything's going to be fine, love business as usual. Well, that's really not going to be the case. But also saying there's nothing good happening and there's no way we can get out of this, that's not all the case either. So I think we have to have a more analytic, pragmatic view of the market and how we can get our talents and into the market and help our customers. Look, the housing market, I believe, this is my opinion, I'm optimistic, it's going to recover with strength. Is it going to be difficult? Yes. This is not going to be an easy path. And one thing I would recommend, I'm hearing from real estate agents, I'm hearing from lenders, buyers, sellers, things like if interest rates aren't low, the market's going to be decimated, or nobody's going to be able to buy a house, or we're going to get foreclosed on, things of that nature. Just be cautious. Whenever you come to an opinion, my advice is this: put it in some foundation of empirical facts. So let's look at the housing market pre-COVID-19. Right now, the median loan to value in homes that have mortgages against the United States is 54%. That's wonderful. That means our market is well collateralized. That's good news. 40% of the homes in the United States are owned outright. Big number. Unemployment prior to this happening was at historic lows, and foreclosure rates, historic lows. Now, look, we shattered this week records unemployment. Look, we know that people are going to have difficulty and challenges paying their mortgage, so we expect to see those challenges come through, and lo and behold, in unemployment, we certainly did this week. But we started from a position of strength, and that's what's important. PCE, the Fed's favorite measurement of inflation, was at 1.8% in February. It's great news. Low inflation. We need low inflation. It ain't going to last. We're going to have high inflation, or higher inflation, I should say. But at least we started from a position of strength. February earnings even increased 0.6%. That was actually, expectation was 0.4%. So February earnings were higher. Now that's not going to hold through March, April, May, June, July, whatever the time frame is. But at least we started from a position of strength. And then also the stimulus package that was put out this week. That's really going to help the market, and it's going to help people, assist people. Do I think it's a cure-all? No. Employment is eventually going to be the cure-all. But the stimulus package will help us get there. So what's my opinion on that? There are some core kernels, there's some core strengths in the marketplace that we as professionals need to understand. Guys, there was weaknesses in our marketplace as well before this all happened. I have been saying for months that interest rates were too artificially low because of the Fed lowering the federal funds rate and QE, or quantitative easing. I'm going to talk about that here in a second. We're seeing some exacerbated or exaggerated effects of quantitative easing, and we're seeing it right now in the marketplace real time. And I'm going to talk about that in just a second. So, we've got to work through those dynamics, but I think we're going to come out stronger. The other thing is, guys, it was heavily a seller's market with rates as low as they were. I think that's going to flip. I think we're going to see a buyer's market, or more of a neutral market, where buyers and sellers really are getting equal benefit. And I think that's overall healthy. Let's talk about market dynamics for a little bit. Mortgages are subtle, they're complex, and they're nuanced. The mortgage market is a very complex market. It's intertwined and connected to the federal treasury, federal funds rates. It's intertwined and connected to the stock market, and it's very connected, obviously, to mortgage-backed securities. They have relationships and how these industries structure, how they bring their product to market, the cost structures that affect these industries. And, these markets like to play in a nice, calm, stable sandbox where nobody's interrupting them and they can kind of get along and trade, go back and forth, strengths and weaknesses, and they like stability. Well, when a rainstorm comes and just makes that sandbox a mud box, you kind of get this sense where, each one of those players, the stock market, the Fed, the mortgage-backed securities, they kind of want to take their sand pail and their sand shovels and go home. And they get broken and it's dysfunctional, and that's where we're sitting right now. So if you are an agent out there or a lender or a borrower or a seller and you're thinking, I've heard this. If interest rates don't return to where they should be, the market's going to be decimated. I have to be honest, you're missing the understanding of the nuances in the short run that are coming into play. So I want to see if I can explain this a little bit. Before I do that, I want to make sure everybody understands. Here are my sources. I use Barry Habib of MBS Highway for really the vast majority of my financial understanding of the mortgage markets. There's an article that I'm referencing here on this page that I'm going to link. It's already on my Facebook page. It's so you can get it there. I'm going to link that again when this goes up on YouTube today. I strongly encourage you to read this article. It is very important, and it explains in layperson terms the complexities of the mortgage market. Now, you got to understand, in the short run, rates must increase to bring stability to this market, and here is the why. It's counterintuitive, it's complex, it's hard to understand. But here's the reason why. The biggest issue that's facing right now these wholesale and retail lenders, and so, I'm on the front line. I'm talking to account executives. I'm talking to these people all day long, every day, is they're getting margin calls. And I'm not going to get too deep into this because Barry will do it far, far better than I ever could. But they're getting margin calls because the Fed is buying like $50 billion in mortgage-backed securities every day. Well, when that happens and the actual market for that is much smaller, the hedging positions of the wholesale and retail lenders get decimated. It adds cost. They get a margin call. And so now instead of using liquidity to fund loans, they got to go pay off margin calls because their hedges came out wrong. And the Fed is exacerbating that because they're buying so many mortgage-backed securities in this kind of attempt to keep interest rates low. It's actually hurting us. And until rates rise so that the wholesale investors and the retail investors can clear their pipelines out and reestablish more of a stable market where they can understand their cost structures of hedging, of servicing the loans and their capacities. Until that happens, we're not going to have a real stable predictable mortgage market, and a stable, predictable mortgage market is a market that equals lower interest rates. It's counterintuitive. I strongly encourage you to read Barry Habib's article, which will be linked. And the last thing I'm going to say on this is we as a real estate industry, we really have a responsibility to be able to explain this to our borrowers, to our agents, to our lenders, all interested parties, because if we're just going to our default position that interest rates have to be low to be healthy, it's just not correct for the short run right now, number one. Number two, it doesn't really stand the smell test of time. I got some gray hair on my head. I remember interest rates at 16 to 19%. And guys, look where we're at now. We have a really robust real estate market, and it wasn't decimated. There was a period of time, and you can talk to my brother-in-law in Southern California who's been selling real estate as a high performer for 35 years. He remembers when 9, 10, 11, 8% interest rates were great. When I purchased the house I live in, I had an interest rate of 5 and 3/8, and I thought that was the greatest interest rate on the planet. My point is this. We have a responsibility. We have to understand the market. Let me go back, sorry. We have to understand the market so we can get good advice as professionals to help buyers and sellers understand how to take the advantage of the market that we are presented with. I put this up, may look familiar, a couple weeks ago. Here are a couple ideas of what we as an industry can focus on in terms of uncertainty. Look, refinance in the short term if you can, that's somewhat evaporating now because rates are going higher, and I hope they go a little bit higher here in the short run. You can always shorten the term on your existing mortgage. That is always a great play. And I think we're going to go into a buyer's market, and I think we're going to have some inventory loosen up. So those are things to think about. Long term. Guys, inflation and unemployment was always coming. COVID-19 just brought it on us a lot faster. We were going to have to deal with this. It's why I've been saying for months that interest rates were too low. If you look at my previous videos, you'll see that I have always been concerned about unemployment and inflation. And those things are upon us now because of COVID-19. But I hate to tell you, they were going to come anyway because it's the economic cycle. Purchase is always better than renting. Those dynamics are not going to change. There's going to be tax advantage for purchase over renting. That dynamic is not going to change. So a market exists, and if we understand it, I think we can get through it together and we can make good, healthy decisions. The last point I'm going to leave you with here, thanks for checking out my content, is this. Guys, no matter what the economic climate, if we make quality real estate and mortgage decisions, we're going to get through this pretty well. And that's kind of been the history of the American economy and who we are as a people, is that kind of good, rational, pragmatic decision making, regardless of what it's in, always rules the day. Look, surround yourself with a very strong real estate team, a very strong financial team, and you're going to find that there are opportunities in the market that you can use, and those opportunities will help us heal more quickly. The last thing I'm going to say is resist the temptation to market time. I have heard numerous stories over the last weeks from colleagues in this industry where people are getting an interest rate, a really good rate, sub 4, for refinances, and they're saying, we're going to wait and see what the market does to get better. Folks, we are in a position of instability. Don't market time. If the financial deal works for you and your family, meaning it's the right house or the right refinance, pull the trigger. If rates go up, you made the absolute correct decision. If rates go down, you're going to be able to refinance downstream. That's what happens in a healthy market. Look, make sure you read that article from Barry Habib. I hope this has helped. Stay optimistic. Use good decision-making tools. Get great advice. Don't default to the simple of interest rates have to be low to be a healthy market, because it's just not how mortgages work. Let's give good advice to our customers. Let's have buyers and sellers ask great questions of us. I hope that helps. Call, message, email, or text me anytime. I am more than happy to do anything I can to help out. And listen, stay healthy and stay safe. I hope everybody has a great remainder of the week. Thanks again for joining my blog.